Hello and welcome. If you're a homeowner at or near retirement, I'm willing to bet you've seen those ads on TV for reverse mortgages. They make it sound pretty simple, a way to get cash out of your house. But the truth is, it's a pretty complex financial tool, and it's not always easy to understand. So in this explainer, we're going to break it all down for you and for your family.
And that quote from Forbes really hits the nail on the head. That's exactly why we're here today. Our goal is to give you a really balanced, clear-eyed view of both the good stuff and the potential risks, so you can have a smart, informed conversation about whether this is the right move for your financial future.
So here's our roadmap. We'll start with the basics. What even is a reverse mortgage? Then we'll get into the nuts and bolts of how it works. After that, we'll look at the potential benefits. And then we'll flip the coin and look at the risks and costs. We'll cover what happens when it's time to repay the loan, and we'll wrap it all up by helping you answer that big question: is it right for you?
Okay, let's dive right in. First things first, what exactly are we talking about when we say reverse mortgage?
Well, the name kind of says it all. Think about your regular mortgage. Every month, you pay the bank. With a reverse mortgage, the bank pays you. It's a way to take all that wealth you've built up in your home over the years, your equity, and turn it back into spendable cash without having to make a monthly payment.
And this really gets to the core of why these loans were created in the first place. They're designed for folks who are house rich but cash poor. You own this really valuable home, which is fantastic, but your day-to-day cash flow for retirement might be a little tight. This is a way to unlock some of that value without having to sell the home you know and love. So how does this whole thing actually function? Let's get into the mechanics a little bit. Now, this right here is the fundamental difference, and it's so important to get this. With a standard mortgage, every payment you make builds your equity and shrinks your debt. A reverse mortgage is the exact opposite. As you get money from the lender, your loan balance gets bigger and your home equity usually shrinks because interest is being added to what you owe month after month. Now, not just anyone can get one. You've got to be at least 62, and the home has to be your main residence. You also need to have a lot of equity built up. If you still have a little bit left on your original mortgage, that's okay, but the reverse mortgage has to pay that off first. And see that last point? You must go through a counseling session with a HUD-approved counselor. That's a really important consumer protection step to make sure you know exactly what you're getting into. And you also get some choices in how you receive the money. It's not one size fits all. You can get it all at once in a big lump sum. You get steady monthly payments for a while, or you could set it up like a line of credit that you can just draw from whenever you need it. You can even do a mix of these. Okay, so let's talk about the appeal. Why do so many people consider these loans? Let's look at the advantages. All right, the biggest pro is right there at the top. No more monthly mortgage payments. For a lot of people, that's huge. It can free up hundreds, maybe even thousands of dollars a month. It also lets you stay in your home to age in place, which is a goal for so many retirees. Plus, the money you get is tax-free because it's a loan, not income. And that last point is a critical protection. It's what's called a non-recourse loan. In plain English, that means even if the housing market tanks and your loan balance somehow gets bigger than what your house is worth, neither you nor your kids will ever be on the hook for the difference. Now, let's look at the other side of the coin. These loans are definitely not free, and it is absolutely crucial to understand all the costs and potential downsides involved. Let's start with a hard number. For the most common type of reverse mortgage, called a HECM, the maximum origination fee a lender can charge is $6,000. And honestly, that's just the beginning. You see, there are several layers of costs here. You've got that origination fee, you have mortgage insurance premiums, all the standard closing costs like appraisals and title searches, and sometimes even a monthly servicing fee. And that mortgage insurance, that's what pays for that non-recourse protection we just talked about. But here's the kicker. All of these costs are usually just rolled right into the loan balance itself. That means your debt grows faster and your home equity gets eaten up more quickly. Okay, this is so important. A reverse mortgage gets rid of your monthly loan payment, but it does not get rid of the costs of being a homeowner. You are still 100% responsible for paying property taxes and homeowners insurance and for keeping the house in good shape. If you fall behind on these things, you can actually default on the loan, which could, in the worst-case scenario, lead to foreclosure. So, if you're not making payments, when exactly does this loan have to be paid back? Let's talk about what happens when the loan finally comes due. This is it. This is probably the single biggest question that seniors and their adult children have. Does the bank just take the house, What happens to our inheritance? Let's clear this up right now. The loan has to be paid back when one of three main things happens. The last borrower on the loan sells the home, moves out for more than a year, say into a nursing home, or passes away. When that happens, your heirs have very clear choices. If they want to keep the house in the family, they can pay off the reverse mortgage balance. What's more common is they'll sell the house, use the money to pay off the loan, and then they get to keep whatever is left over. And because of that non-recourse feature, if the loan is more than what the home is worth, they can simply hand the keys over to the lender and walk away. They are not personally on the hook for the debt. So, we've gone through a lot of information here. After weighing all of this, how can you and your family actually decide if this is the right path to take? Well, a reverse mortgage tends to work best in a few specific situations. If you are absolutely planning to age in place and stay in that home for the long haul, it could be a fit. If you really need a steady stream of extra income to supplement your retirement, it can be a powerful tool. And it's a lot more appealing if passing down the physical house, free and clear, isn't a top priority for you or your family. On the other hand, there are some pretty clear red flags. Because those upfront costs are so high, this is a terrible short-term solution. If you think you might move in a few years, you should probably reconsider. If you're already having a hard time paying property taxes and insurance, this loan won't fix that. It could make it worse. And of course, if your main goal is to leave the home to your kids without any debt on it, this is definitely not the product for you. So, what's the number one takeaway from all of this? It's simple. This is not a decision you should make alone. It demands open, honest conversations with your family about everyone's goals and expectations. And most importantly, you should seek out impartial, professional advice from a HUD-approved counselor. Remember, their job is to help you, not to sell you anything. At the end of the day, a reverse mortgage is just one tool in the financial toolbox. The real question you and your family have to answer is whether trading some of your home's equity for cash flow today is the right key to help unlock the comfortable and secure retirement you've worked so hard to achieve.